name is Orhan Sarayli. I'm a managing director at Barings Global Infrastructure Group. I've been with Barings since 2014 and have been involved in the infrastructure space for far longer than I really want to talk about.
That's great. So can you just talk to us today about the case for investing in infrastructure debt in 2024?
The case for investing in infrastructure debt in 2024 is an evolving case in that it continues a lot of trends that we think have been in place for a while still reflecting the continuous need for growth and evolution in the space. For one, the entire world and throughout society continue to grow. We have an aged infrastructure throughout the world. We have lots of areas that require infrastructure just for the societies to get to a level where the rest of the developed world is. But on top of that, you have a lot of challenges in terms of environmental challenges, infrastructure resiliency, and evolving and adapting to the changing world. The essentiality of infrastructure is what is the critical item. And that essentiality is a positive for society in our view. But just as important for investors, that essentiality is what gets the investors the recovery of their capital and the return of the capital that everyone is looking for.
Fantastic. Yeah, thank you for talking about those points. So, what key trends are you seeing that you think will shape infrastructure debt investing in this year and beyond?
Yeah, the key trends that we see affecting infrastructure for this year and in the near term future are items that we've definitely been tracking over the last couple of years. First and foremost is the continued decarbonization going on throughout the world. The movement away from traditional fossil fuels towards more sustainable fuel resources is one that has been in process and will continue to be in process. And that's not just a near-term thing. This is something that's going to take decades. It will take a lot of investment and a lot of global coordination to get there. So that one is a theme that's absolutely going to be consistent across every investment platform going forward. But on top of that, a primary driver there is definitely electrification. And you see it right now when you tie into the fact that there are a lot of governments supporting with the Inflation Reduction Act in the US is a great example. We expect to see that to continue to advance. And there's a lot of investment opportunities popping up that weren't in existence 5-10 years ago that we're seeing coming up foremost. So you're definitely seeing infrastructure expand in terms of what opportunities are available there. Tied to that as well is the increasing trend of digital infrastructure. In our portfolio a couple of years ago, digital infrastructure probably represented 1% to 2% of our entire portfolio. Now it's at 7%. And it's going to continue to grow, and it'll get into the double digits within the next couple of years, in my opinion. And when you layer on some short-term trends, the last couple of years, the economic cycles we've been going through and the interest rate and inflationary aspects have heightened, I think, the importance of infrastructure to investors and to borrowers. And what we're seeing now is there's been a bit of a slowdown in M&A activity and other types of activity, investment activity. That is starting to open up again. So in 2024, we anticipate more organic deal flow than we saw in 2022 and 23 due to some of the interest rate disruptions.
Yeah, that's interesting you would mention the M&A activity because it's something we're following pretty closely in our newsline, and we've seen a lot of big transactions closing lately. So that must be kind of that evening out maybe from previous years. So what kinds of investors do you expect to see increasing allocations to infrastructure debt, and why?
In terms of investor appetite for infrastructure debt, there's been a traditional base of investors, I think, who have been continually supportive. The banks have traditionally always been the largest lenders to infrastructure debt. Insurance companies have been there for quite a long time as well. And we have a lot of insurance company investors already that we manage money for. Over the last 5 to 10 years, we've seen increasing interest from pension funds. Traditional institutional type investors such as pension funds, sovereign wealth funds, who have always been invested in various types of asset classes. Their foray into infrastructure primarily in the past, I would say, came through investing in infrastructure equity funds. And we have noticed over the last 12 to 18 months, increasing dialogue from them in terms of their interest in infrastructure debt, which is not too surprising given in a time of disruption with interest rates where the yields we are seeing on our investments have gone up in a time where, as I mentioned, M&A activity has kind of slowed down. The ability to get what we think have always been very attractive returns for infrastructure equity on the infrastructure debt side now has had some what we think appeal to certain investors that traditionally never really considered it a vital asset class. And then there are obviously other investors that are increasingly becoming more active. Fund to funds set up by asset managers is something we are getting into more dialogue with, and family offices and wealth management channels. Areas that historically we have not had a lot of dialogue with, we are getting inbounds on. So yeah, it's definitely diversifying the investor base for infrastructure debt, which is a great thing.
Yeah, absolutely. So, as an increasing number of infrastructure deals are being directly originated and privately negotiated, what should investors look for in an infrastructure manager?
It does place a lot of burden and emphasis on making sure you have the right teams looking at the deals. It's very important, I think, to set the context that historically the vast bulk of infrastructure deals have been done privately, mostly by banks, frankly, at least in the private infrastructure market. I'm separating that from the municipal tax exempt financing market that also has been responsible for a lot of infrastructure to date. In the private infrastructure market, this is not the kind of paper you can go out and find on your Fidelity account or looking up on Google Finance or whatever. In a large part, you either need to know the sponsors directly or you need to know the lead banks or advisors. And it's in some ways, in many ways, it's deal by appointment and not by just trying to work out the latest syndicated process. So having the origination platform is important at Barings. That's a main reason why when we built up the composition of our team, I'm a former banker, having originated infrastructure deals in my past. Our team consists quite a bit of a lot of former bankers like myself, who our entire job was to go out there and deal directly with the sponsors and get them the financing needs that they required. So definitely the origination is a big part of it. I think tied to that, though, is having a team with experience that can handle cycles. As much as we certainly do admire and appreciate infrastructure's track record of being resilient through various economic cycles and having very attractive recovery rates throughout those cycles, you still need to manage through those cycles. You still need to manage the deals. You need to manage the borrowers. You need to manage your positions. We focus very much as we look at our team in terms of having the right composition of folks that have been at buy and hold institutions and who have lived and breathed these deals both in good times and bad times. And that is something that, again, finding the deals is one thing, managing the deals is another. Infrastructure is a global business, and it is not just one little subcomponent. It's not one industry. There are 6 sectors that we categorize infrastructure into. And we believe investors who invest in infrastructure want to invest across all 6 sectors in a diversified global model. Barings has a lot of different skill sets, a lot of different asset classes, and we are globally diversified. And we believe it's our presence allows us to then bring the full depth and breadth of infrastructure debt that investors are looking for to them.